Guys, thank you so much for coming today. I know each and every one of you is extremely busy, and so it means a lot. I'm very flattered that you would take just a little bit of time out of your day to get some updates and thoughts on where the market is going, what's going to be happening, and I really have three main topics to go over today. So if all goes well, we'll get you in and out of here in like 25, 30 minutes. So you can take the information and you can get off and you can start selling some more homes with armed with everything. So the first thing that I did want to go over is what we're calling my economic update. So well, hang on a second. We got a lot of people in my waiting room here. Hang on. How do we turn the waiting room off? That's what I want. There we go. There we go. Okay. So Kevin, can you see my where it says Realtor Update? Gmail check for me. Okay. So the first thing that I wanted to do is to go over interest rates. So obviously everyone wants to know what are interest rates going to do in the next couple of weeks and years. And so what I wanted to do is just kind of share with you what's really happening in the marketplace and why it really doesn't have a function about the real estate market per se itself. Interest rates have been intentionally pushed extraordinarily low by the Federal Reserve Bank. That's really the nuts and bolts of it. So I want to share you what you guys may have never seen, but this is really where interest rates go and how they look. So hopefully you guys can see a chart with a lot of red and a lot of green on it. Okay. So this is actually mortgage bond pricing from the last for 30-year fixed rate loan from the last 6 months. So when I'm talking with clients or you're talking with clients, what you really need to do is you need to equate interest rates with the stock market and a bond market. So your mortgage, my mortgage, everyone's mortgage is packaged up, put together as a bond and sold through Fannie Mae or Freddie Mac. That is a live investment. Large insurance conglomerates, investment companies, and now the Federal Reserve will buy that mortgage. It will pay a return. That's the interest rate that the borrower is paying. And that is bought and sold on the market. So the numbers on the right here, they are the price of a bond. So you get a package bond together of a 30-year fixed rate loan, and it has a price. And as you can see each day, and these are the days down here, that price is going to go up or down. Okay. So the higher the price, the lower the return to the investor. That also means lower interest rates. The higher the price, the investor pays out, takes more money from the buyer and pays them less return on their money. So if nobody wants to buy a mortgage-backed security, which is what happened in March, the price goes way down. You have to make it cheaper and you pay a much higher return on the investment. And that is why interest rates spiked in March. Starting in March with COVID, the Federal Reserve Bank has come out consistently again and again and again and said they will continue to buy our mortgage-backed securities no matter how high the price goes in order to keep the interest rates lower. So for about the last year now, I guess it is, about every day, $4 billion to $15 billion worth of our mortgages have been bought by the Federal Reserve. Now you can see there are basic fluctuations, but overall, if I scroll out just a little bit more, it's going to, let me get a different viewpoint here. But for right now, you're going to see that the price really hasn't changed very much, kind of between 103 and 102. What that means is the Federal Reserve is giving stability in pricing. You can see though, it doesn't always stay flat. There are times where the price goes way down and then goes back up. So that's why your clients may be hearing that there's fluctuations in the marketplace, what's going on with interest rates. But the point being is that so long as the federal government, and they just came out on Wednesday again, saying that they are going to continue to buy our mortgage-backed securities, you're going to see the pricing be in a pretty flat range. And so the answer is that interest rates will stay, are going to stay flat for the foreseeable future. Now, what's going to make interest rates rise? Really one word, and that word is inflation. So as the economy opens up again and you start to see there are more people going out to work, there's like trillions, $2-3 trillion worth of money going into the marketplace. That is going to create inflation. Inflation is going to weaken the pricing of a bond. And so the long story short is that as inflation goes up, you're going to see interest rates go up. And here's a simple analogy. If inflation is at 2% and you own a treasury bill from the government that's only paying you 1.5%, you are losing money on the investment. So the only way to offset that losing money on the investment is to start paying to over 2% to offset the cost of inflation. So what you're hearing about on the news and on the previous chart that I showed where there was that red falling price at the start of the year is fears of inflation. That is nothing that you and I can control, but it is going to be out there. So what happens if there's a rate increase? Yes, I'm actually talking about rates increasing a little bit. It's going to affect the affordability of pricing. Obviously, with the purchase prices going up as high as they are right now, you are starting to get buyers that are just simply unable to afford the house. Now, one of the reasons why a lot of people can is because the interest rate is so low. However, once that interest rate goes up 1/4 to 0.5%, you're now talking $50 to maybe $150 on a monthly payment. That is going to affect negatively the affordability of a lot of borrowers. So it's a real conversation that we should have, not to create any more panic buying that we already have, but certainly to inform them that interest rates will be low for the foreseeable future, but they do fluctuate. And if that contract comes in or the borrower waits too long, the math, as you can see down here on the bottom here where it says a 1% increase in rate and a 10% lower payment is actually a higher payment than now. The math does not work the way most buyers think. If there is an increase in an interest rate, but the price point of the houses goes down, the math still works that it's cheaper to buy right now with the lower interest rate. So it's a way to get some of these buyers off the fence. I know that there's a lot of buyers out there and the real problem is for inventory. That's for the next conversation, but I want people to really understand that interest rate is not going to stay this low forever. Already the refinance market is starting to slow down a little bit. There's only so many people you can refinance. And at some point that interest rate is going to pop up. And I think that if you're a professional and you tell them up front that at some point it's going to have to move, you're going to look like the champion and you'll make them happy. And you've given them good advice. So that's kind of the interest rates there. Next thing I want to talk about is appraisals. Okay. Appraisals are a problem for a lot of people right now. And it's not that the actual appraiser is doing poor work. I really haven't had very many low appraisals. The problem is time frame. So this is a relatively accurate picture because when I have read and heard is that the average age of an appraiser is 63 years old. Now, that's not saying one thing or another. I'm just telling you that a 63-year-old may not be moving quite as fast as us in the marketplace. So what you're running into is a capacity issue from the appraisal side. This happened a couple of years ago where we could not get the appraisals turned around fast enough. And it's really kind of like getting out of line. Imagine if you were driving to Tahoe this weekend to go up to the snow, your kids got to use the bathroom and you get off the freeway. Now you have to get back in line and you're further back in line with the appraisal process. So not every property is going to have a waiver. The appraisal turn time is becoming a problem. Most places now are about 2 weeks out unless the borrower is willing to pay for the appraiser to go out on a rush. It is probably not going to come back in 7 days. The further out of the urban areas that you go, the longer the turn time is going to be. So I have had some up in Somerset and Cool, where there's fewer appraisers. Now you have a little bit of weather, and they're all older. They take a little bit longer to put together. So the problem is that how do we strategize around that with needing to put in offers or accepting offers on your listings where everything needs to be done super fast? I don't really know what the answer is. I'm just trying to present what the problem is so that we can all be really aware. There is no way to do the appraisal portion of it much faster. Most lenders go to 1 or 2 AMCs. All the appraisers are independent contractors. They are on all the same panel. So it's not like going to, Guild and then going to Umpqua Bank or, Movement Mortgage is going to somehow get you a whole new group of appraisers. Appraisers put their name on all the different lender panels. So it's kind of the same group. So it's just really something to be aware of, is that appraisals are taking a lot longer. What I would suggest, certainly what we do on our team, and I would encourage you to talk to your own lender, is make sure that when that the contract is received by the lender, that you get a confirmation that the appraisal is ordered the same day. You have to at least get that order in and get it out there to be accepted in order to have a chance to meet that deadline. The other thing to note for your government buyers, FHA loans and VA loans in particular, you cannot order the appraisal until the file is disclosed. And that takes a couple of days. Escrow's got to send in everything. We got to make sure that the file goes out and it's accurate. So it could be 3 days on a government loan before an appraisal is actually ordered, which now if you have, again, a short time frame on the appraisal, then it's going to back up against those time frames. So if everyone's aware of it, usually people are reasonable, but I just want to make sure that we go over the appraisal turn time is something that we're going to have to deal with. Now, if refinances slow down, and they are all forecasted to do so, then that's going to come back as well. But at least for the foreseeable future, maybe next 6 months, it's something to deal with, okay? Now, the other thing to talk about, of course, is the IRS. So this is a picture from, I can't remember the movie that just came out, but it's hilarious and it's pretty accurate as well. The IRS tends to be slow to begin with. And now they are on COVID, and they have been working remote and less hours, and they have a backlog miles and miles long. So the issue that you're going to have with the IRS is for self-employed borrowers and any other borrower that needs information from their 2020 tax returns to use to qualify. So let's say rental income or dividend income, maybe a K-1 that they receive from a business. That tax return has to be filed and validated in order to use the income. So if you have someone and they are a self-employed borrower, maybe they pay themselves a W-2 because they have an S-Corp, you cannot use that W-2 income for 2020 until those tax returns are filed. And it is going to be a line longer than the vaccine line to get taxes through. There is really no way around getting those taxes validated. If you have a client that is selling a house to someone who's self-employed, you're going to have a late closing. So I really, if you only listen and do one thing after this, please make sure all of your buyers, you have discussed what is going on with their tax returns. And if you are accepting, if you're listing properties and you're looking at offers, the amount down, the quick turn time is not the most important thing. You got to call the lender and ask about the buyer itself, because you can get everything in and through, and then you could be waiting weeks for the IRS to validate the tax returns. Now, I put in here 2 little asterisks on there. If you can't validate, you can't use the income. No exceptions. Well, there's always exceptions, right? You know me, I always say everyone knows the rules. I just know what all the exceptions are. There's a very, very small exception. And what you would have to do is basically create a mountain of paperwork for the underwriter to look at, to basically show that the file has been received by the IRS, and they have everything matched up. The California returns, there's been no adjustments, and then it is 100% up to underwriter discretion. I just today closed a loan for a friend of mine who's a CPA, and it was on a jumbo loan, and he's a CPA himself, and his 2019 returns have been filed, but the IRS would not, their website did not show that the returns had been validated. And so we had to get my corporate management and Chase to do an exception on a 50% loan to value for a CPA to show that he had filed his taxes on income we weren't even using. That is how important this matter is. So if you have people and the lender doesn't know what they're doing, you are going to run into obviously some time delays, and time delays are never good. It costs everybody money. And then if you have, one of these, domino effects, it's going to get rather contentious. So again, just like appraisals, really, really important to talk about this up front. Look at the calendar, know who the buyer is on both sides so that you're aware, and then you can set the proper expectations. It's going to be a big thing coming up the closer you get to April. So those late filers, they are going to be, it could be until May or June before it's validated. It's going to be that big of an issue. So what we're doing, just as an example to share with your other clients, with other lenders, is I am telling all of my clients that they need to file immediately. That's the number one thing they can do to make sure their pre-approval is set up, so you can at least get in line and start documenting that the income is filed. By the way, that old trick of going to the IRS and having them rubber stamp it, can't do that anymore because you can't go to the IRS. So it is something that needs to be monitored, okay? Last thing here is I have a new product that's going to solve a lot of problems for you. So I don't have any sound. You're going to have to do a drum roll in your own head. But for those people who need to go non-contingent, because non-contingent borrowers don't have a lot of opportunity here, we just announced a bridge loan through Guild. So I'm super, super excited. This is going to help out a ton of people. This is really a private loan from Guild that is a true bridge loan. So obviously there's going to be some guidelines along with it, but here's how it's going to work. So let's say you have a buyer who needs to sell their house, obviously, to get in a new house, and they've been beaten out on like 75 different offers, right? They just can't get anything accepted. So what we are doing is we are doing a short-term loan on their current property. That property has to be listed for sale, or it has to be in contract for sale. So all of the clients that are just waiting to hold on to put their own house on the market till they get into contract, now this is another way to incentivize them to get that into contract, or excuse me, at least on the market. So it's going to be a loan between, I think it's $40,000 and $250,000 the limit. There's some criteria on how they qualify for it, but what would happen is it's an interest-only loan on the retained property that can be used for a down payment on a conventional loan. This is not going to qualify for jumbo loans. So our max loan limit's $598, but it will allow them to come up with a down payment they would normally need from that retained property, buy the new house, and then the other house, the retained property, would be sold. So it is a true bridge loan. It is not something that gets run through another bank. It's not a line of credit. It is a bank or Guild loan that we are doing to help people get in, because we realize that you just can't get these offers accepted. There are some criteria. Not everyone is going to qualify, because you have to make sure you kind of hit the steps for it. But it is a way some of your clients would have an opportunity to go in, and then we talk about with the client about how can they pay down the mortgage after closing. So I sent out a flyer on it the other day, and certainly I'll give you more information. I'm going to put out something else next week, but it's a great opportunity to have a conversation with your clients to get them out, get them looking again for properties in a way that is a little bit different. So I'm pretty excited to announce that. So we're pretty good on time here. We're at 22 minutes in. Those were my slides. I see I have a couple of questions, so let me pull that off, and then we'll open this up to some questions here. So one of them came in was, at what point will 2020 taxes be required? That's a very good question. Okay, so we're going to get into the weeds a little bit here. So again, we're presuming a self-employed borrower. So right now, today, a self-employed borrower, we would have to use the last 2 years' tax returns, so 18 and 19. And then because of COVID, the rule is that the 2020 taxes are not used. We have to get a year-to-date balance sheet and P&L, and now 3 months bank statements that show whatever the income is on the P&L, it's matched by deposits coming into the business bank account. So now we have an expanded worksheet where we can get in and we can put the numbers from the P&L. Now, you or your clients are the ones who are going to create the P&L. So they can put in whatever they want on there, but it does have to be reflected in the business bank statement. So where a lot of people they were just putting in whatever they want, as soon as they had to show what their business bank accounts were, that kind of went out the window, because the revenue actually wasn't there. So for right now, you can go off the year-to-date balance sheet and P&L, and again the bank statements. And if that number works, then you're fine. You don't need a 2020. At some point, my guess is probably after April 15th, unless they extend that date again, in order to use that 2020, you're going to be required to show that you have filed it. It wouldn't surprise me that as the numbers come in for 2020 for self-employed borrowers and the real losses are actually now being realized, that Fannie and Freddie might change their rules, tighten it up again for self-employed to show that, you know, that's a real number. Right now, you can do an audited P&L, which would get rid of what I just told you, but an audited P&L is very timely and very expensive. So no one's really done that. So for self-employed borrowers, if you're talking with a borrower that's self-employed, I would not show them a house until whichever lender you work with has done a thorough job and you've asked some questions. And the question I would ask is, have you done the Fannie Mae worksheet with their P&L? Because that's really what the underwriter is going to be asking for, or they're going to be doing. So we do the worksheet up front. So I know that my numbers work, and unfortunately it stops some people in their tracks. There's always little things that you can do, but don't waste your time if they haven't gone through those steps, because what's going to happen is you're going to go through and you're going to work your tail off showing somebody how to get into a house, and then you're going to give them in a contract, and then you either have a disaster because they don't qualify, or you have the 2020 or they haven't done their 2019 taxes, and now you are trying to save a deal that's going to close extremely late. So great question. Okay. Any other questions about rates, appraisals, or anything like that, or taxes?
Brad.
Yeah. Sure, Kevin.
So a bridge loan compared to a HELOC, is there any advantage going one way or the other regarding interest rates? I know there's a balloon payment with a bridge loan, but what would be the advantage one over the other?
You know, you'd have to look at both of them, because a line of credit is going to be an institutional loan. There's going to be a lot more paperwork with it. So for our bridge loan, we would do it all at once. We would run everything through. We only need to obviously work with one set of documents. The interest rate on ours is, my guess is going to be around 5.5 or 6%, which is probably right where a HELOC would be. The question would be, is that if you took a HELOC out on your property today, and then in 30 days you were to sell that property, I can almost guarantee that all of those HELOC lenders will back charge and recover the upfront costs for the line of credit that was incurred in order to push that through. So it's a good question. If the line of credit or the bridge loan doesn't work, then a line of credit might as well. Usually when we're talking with people, Kevin, we go over, hey, let's look at what's the cheapest cost of funds. I'm not married to one or the other. My goal is how can I get a client comfortable to get into a house, put an offer in with a down payment, and be comfortable with covering the monthly payment, potentially carrying 2 mortgages, or I guess 3 if you include the bridge loan, for a short period of time. There are some people that won't care and they'll just do it. Other people, now have we given them the tools to get into the house? Yes, but we have to get them comfortable with it. So we would look at all the options. Okay, great question. Okay. Anybody else have other questions that I can help out with? Is that helpful, James? It's nice to see your face. Nod yes if you thought that was great. Awesome. Okay. Well, listen, this is recorded, so I will package this up and I will send it on over. Please share it with anything or anybody you want. This is not proprietary. I'm just trying to get out some good information. Really look at the dates and the reality of the situation with your clients and the time frame.